Hi everyone, I'm Rich Hoffman, National Sales Director at AD Mortgage. Today, we're taking a deep dive into conventional loans, what really matters for brokers, where speed usually gets lost, and which lesser-known details can help you close more loans without the unnecessary back and forth. Let's start here. Conventional loans make up the bulk of the market, about 2/3. So if your client has stable income, a reasonable credit profile, and money for a down payment, chances are they'll go conventional. For loan originators, conventional is the foundation of your pipeline. And here's why it's critical. The market is highly rate sensitive. Sometimes, 1/8 of a point is the difference between keeping a client or losing them. That means that speed and accuracy are everything. Now, let's talk about the team. A good conventional loan really depends on an experienced underwriting team, one that doesn't add just-in-case overlays and knows how to read findings quickly. At AD, that's where we put a big focus. We follow the actual Fannie and Freddie selling guides, no extra overlays, and one of the most seasoned, experienced agency underwriting teams in the industry. So you get clear, actionable conditions faster. Next is pipeline management. There are two main rules here. Number one, the sooner you know which AUS gives better findings, the faster you'll move the file to closing. And two, the clearer the conditions list for your client, the less time you'll lose chasing paperwork. And that brings us to a key skill, understanding the findings. DU and LPA can read the exact same loan differently. One may ask for more documents. The other might give you a property inspection waiver and no appraisal. At AD, we use AUS Compare, our dual AUS comparison summary. You are able to see DU and LPA side by side and pick whichever gives your client the smoother path. With AUS Compare, you can intentionally choose the option with less friction for your client and for your pipeline. That alone can save days, sometimes even weeks. Okay, now let's get practical. A quick look at DU versus LPA strengths and weaknesses. Let's talk about how DU and LPA actually behave in the real world. With DU, think about it this way. It's more comfortable when it sees depth. A longer credit history, multiple trade lines, stronger reserves. That's its sweet spot. If the borrower's file's a little thin, DU tends to be less forgiving. LPA, on the other hand, can be friendlier with borrowers who don't have that long track record, younger clients, or first-time homebuyers, for example. If they have stability in income, maybe a low DTI, or some reserves, LPA is often willing to give and accept, where DU might hesitate. Similar situation with DTI. DU is usually capped at 50%, and unless there are very strong compensating factors, it doesn't like being close to that edge. LPA sometimes stretches approvals in that 45 to 50% range, especially if one borrower's credit is strong enough to help balance things out. When it comes to reserves, DU feels safer when it sees at least a couple months of PITI in the bank, and more if the rest of the file is marginal. LPA doesn't lean as heavily on reserves, and may still issue an accept with less in savings, particularly for first-time homebuyer programs. For income, DU is a straight shooter. It works really well with W-2 borrowers and predictable paychecks. Self-employed with fluctuating income, it's tougher. LPA can sometimes read variable income, bonuses, overtime, even declining self-employed earnings in a more flexible way, as long as you can show it's stable enough. And on LTV and property types, DU tends to be tighter, with high LTV loans in the 95 to 97% range, and a bit more conservative on condos or multi-units. LPA is often more receptive to those higher LTV scenarios, first-time homebuyer programs, and sometimes more open to 2 to 4 unit properties. So how do you put that into practice? If you've got a borrower with thin credit, higher DTI, or it's their first time buying, start with LPA. If you've got strong credit depth, solid reserves, and straightforward W-2 income, DU will usually give you the smoother approval. And when you're on the fence, don't guess. Run both. Compare them side by side with AUS Compare, and pick the one that gives you fewer conditions and less friction. Last but not least, here's a lesser-known topic that often can make the difference. Canceling mortgage insurance, otherwise known as PMI. PMI doesn't have to stay with the client for 10 years. Yes, it cancels automatically once the balance hits 78% LTV on the original amortization schedule. But that can take a decade or more. But the borrower can request a cancellation. Typically, after 2 years, they can order a new appraisal. If that appraisal shows the LTV at 80% or less, the servicer can cancel MI early. That's a real savings, and a great reason for clients to reconnect with you. Let's pull it all together into a quick broker action plan. Number 1, keep the focus on rate and speed. Faster findings equals a higher conversion. 2, read the findings carefully. Not all conditions carry the same weight. Separate must-have from nice-to-have. Clients need a short, clear checklist. Number 3, run DU and LPA in comparison. Don't guess. The side-by-side results show you the path of least resistance. Number 4, leverage hidden levers. PMI cancellation after 2 years with a new appraisal or Fannie's average median rule, these can save or improve a deal. And last but not least, rely on strong underwriting. A team that explains why in findings and doesn't pile on overlays saves you time and frustration. So how do we handle agency loans at AD? We work without overlays on conventional. We have a highly experienced underwriting team, and we give you access to our AUS Compare. That means speed, predictability, and a cleaner pipeline. The rest is your style as a broker. Honest guidance, clear steps, and tight timeline management. So to sum it up, conventional is the foundation of your business volume. Speed is the currency of the market. And knowing how to read AUS findings while using levers like PMI cancellation and median averaging is what sets apart a good broker from a great one. Thanks for tuning in. Make sure to subscribe so you don't miss our upcoming videos. If something wasn't clear, or you'd like to discuss a scenario, just drop it in the comments. We're always listening.